Hey everyone, welcome back to the channel. Today we are going to talk about something that I think does not get nearly enough attention in the world of real estate investing, and that is the use of real estate as a capital preservation tool. Most conversations about real estate investing focus on cash flow, appreciation, returns on investment, building wealth over time. And all of that is important. But today I want to zoom out and talk about something more fundamental, which is the role that real estate plays in simply protecting the capital you already have. Because before you can grow wealth, you need to preserve it. And in the United States, real estate has historically been one of the most reliable and accessible tools for doing exactly that. So let's get into this topic in depth, because there is a lot to unpack here, and I think by the end of this video, you are going to have a much richer understanding of why so many sophisticated investors, family offices, and high net worth individuals allocate significant portions of their capital to real estate, not just for growth, but for protection. Let's start with the fundamental concept of capital preservation, because it is important to be precise about what we mean. Capital preservation is not simply avoiding losses, it is maintaining the real purchasing power of your wealth over time. This distinction matters enormously because inflation is a constant and insidious threat to capital. If you have $1 million sitting in a savings account earning 2% annually and inflation is running at 4%, you are technically not losing nominal dollars, but you are losing real purchasing power every single year. The goal of capital preservation is to keep your wealth not just nominally intact, but genuinely intact in terms of what it can actually buy in the real world. And this is where real estate becomes extraordinarily relevant, because real estate has a unique set of characteristics that make it particularly well suited to preserving real purchasing power across time and across economic environments. The first and perhaps most important of those characteristics is the relationship between real estate and inflation. Real estate has historically been one of the most effective inflation hedges available to investors. The reason for this is relatively straightforward. Real estate is a hard asset, meaning it is a physical, tangible thing with intrinsic utility. People need shelter. Businesses need space. Land is finite and cannot be manufactured. When the purchasing power of money declines because of inflation, the nominal prices of hard assets like real estate tend to rise in compensation. This is why investors who held real estate through inflationary periods in American history generally found that their properties maintained or increased their real value, even as the dollar weakened. During periods of elevated inflation, landlords can typically raise rents, which increases the income their properties generate, which in turn supports or increases the underlying value of those properties. This dynamic creates a natural alignment between real estate income and inflationary pressures that most financial assets simply cannot replicate. Let me contrast this with what happens to other forms of capital during inflationary periods to make the point more concrete. If you hold bonds, particularly long-duration bonds, inflation is essentially your enemy. The fixed interest payments you receive become worth less in real terms as inflation erodes purchasing power, and the principal you eventually receive back at maturity is also worth less in real terms. Stocks are a more complex case. Equities can be a reasonable inflation hedge over very long periods, but in the short to medium term, inflation can actually be damaging to equities because rising inflation typically drives up interest rates, which increases the discount rate applied to future corporate earnings, which mechanically reduces the present value of those earnings and therefore stock prices. Cash is the most obviously vulnerable to inflation. Holding large amounts of cash during periods of elevated inflation is a slow bleed of purchasing power. Real estate, by contrast, tends to hold its real value and in many cases appreciate in real terms during inflationary environments, precisely because it is a hard asset with utility-based demand and income that can be adjusted upward. Now let's talk about the specific characteristics of the American real estate market that make it particularly attractive from a capital preservation standpoint. The United States has one of the most developed, transparent, liquid, and legally robust real estate markets in the world. The rule of law protecting property rights in America is extraordinarily strong by global standards. If you own real estate in the United States, you have a deeply protected legal claim to that property, backed by centuries of common law tradition, constitutional protections against government taking without compensation, and a sophisticated court system that enforces property rights consistently. For investors from countries with less stable political and legal environments, American real estate is particularly attractive precisely because of this legal and institutional robustness. But even for domestic American investors, the strength of property rights provides a bedrock of security that more financially engineered assets cannot offer. The market liquidity of American real estate is another important capital preservation attribute. While real estate is obviously not as liquid as publicly traded stocks or bonds, the American residential real estate market is significantly more liquid than real estate markets in most other countries. There are active buyers and sellers in virtually every metropolitan area of the country. There is a well-developed mortgage financing system that helps buyers acquire properties with leverage. There are established professional networks of real estate agents, attorneys, title companies, and other service providers who facilitate transactions efficiently. There are public records that make pricing transparent, and there are large and active secondary markets for real estate debt that keep capital flowing through the system. This liquidity means that if you need to exit a real estate position, you can generally do so within a reasonable timeframe, even if not as instantaneously as you could sell a stock. For capital preservation purposes, this level of liquidity is generally more than adequate. The diversification benefits of real estate within a broader investment portfolio are also highly relevant to capital preservation. One of the most fundamental principles of wealth preservation is diversification, specifically holding assets whose values and income streams are not perfectly correlated with each other, so that problems in one area do not devastate the entire portfolio. Real estate has historically shown a relatively low correlation with stocks and bonds over long periods, meaning that when financial markets are under stress, real estate values do not necessarily move in the same direction at the same magnitude. There have been notable exceptions, such as the 2008 crisis, which affected both real estate and financial markets severely, but the general principle of diversification benefit from real estate exposure holds over long periods and across most market environments. Investors who hold a meaningful allocation to real estate alongside their financial assets are generally better protected against the kind of catastrophic wealth destruction that can occur when a single asset class experiences a severe and prolonged downturn. Let's get into the specific mechanics of how sophisticated capital preservation-oriented real estate investors structure their investments. The first principle is prioritizing quality over yield maximization. When the primary goal is capital preservation rather than maximum return, investors tend to focus on properties in high-quality locations with strong and durable demand. This typically means properties in established neighborhoods with good schools, strong employment bases, desirable amenities, and high barriers to supply creation. These are markets where demand is relatively inelastic because people genuinely want to live or work there, and where the ability to add new competitive supply is constrained by geography, regulation, or the cost of construction. Properties in these high-quality locations tend to hold their value better during downturns and recover more quickly when conditions improve. They sacrifice some upside potential in exchange for downside protection, which is exactly the trade-off a capital preservation investor wants to make. Conservative use of leverage is another hallmark of the capital preservation approach to real estate. Leverage amplifies both gains and losses. An investor using high levels of debt to acquire real estate can generate impressive returns during periods of appreciation, but faces severe risk of losing the entire equity investment if values decline significantly, or if cash flow is insufficient to service the debt during a vacancy or market downturn. Capital preservation-oriented investors typically use moderate leverage, maintaining substantial equity cushions in their properties. Loan-to-value ratios of 50 to 60% are common among investors who prioritize capital preservation, compared to the 75 to 80% or higher loan-to-value ratios that more return-maximizing investors might employ. The lower leverage means lower cash-on-cash returns in good times, but dramatically lower risk of forced sale or capital loss in difficult times. Fixed-rate long-term financing is the preferred debt structure for capital preservation in real estate. Adjustable-rate mortgages create interest rate risk that is inconsistent with a capital preservation mandate. When you lock in a fixed rate for 15 or 30 years, you know exactly what your financing cost will be for the life of the loan. This predictability is enormously valuable for an investor whose primary goal is stability and protection. It means that even if market interest rates rise dramatically, your carrying cost remains constant. It means your cash flow projections can be made with a high degree of confidence. And it means you are insulated from the payment shock that can destabilize investors who relied on adjustable rate or short-term financing. Geographic diversification within the American real estate market is another capital preservation strategy that sophisticated investors employ. Rather than concentrating all of their real estate exposure in a single city or even a single region, preservation-oriented investors often hold properties across multiple metropolitan areas with different economic profiles. They might hold residential properties in a stable Midwest market with consistent employment and affordable prices, alongside commercial real estate in a dynamic Sunbelt growth market, and a small allocation to coastal markets with very high barriers to entry. Each of these markets behaves differently across economic cycles. When one is under pressure, others may be holding steady or growing. This geographic diversification within the real estate allocation provides an additional layer of protection against region-specific economic shocks. The role of real estate in estate planning and generational wealth transfer is particularly important from a capital preservation perspective, because it is one of the most powerful tools available for passing wealth to the next generation in a tax-efficient manner. The stepped-up basis rule, which exists under current American tax law, allows heirs to inherit real estate at its current fair market value, rather than the original cost basis paid by the decedent. This means that decades of capital appreciation can pass to the next generation without being subject to capital gains tax, which can be a transformative benefit for families holding highly appreciated properties. The combination of this tax treatment, the ability to hold real estate in trusts and other estate planning structures, and the general durability of real estate as an asset class makes it a central component of generational wealth preservation strategies for many American families.
The tax benefits of real estate ownership more broadly are a significant contributor to its capital preservation characteristics and deserve detailed examination. Depreciation, as we have discussed on this channel before, allows real estate investors to deduct a portion of the value of their buildings from their taxable income each year, even if the property is actually increasing in value. This non-cash deduction reduces the tax burden on rental income, effectively increasing the after-tax return on the investment compared to what the pre-tax numbers alone would suggest. The 1031 exchange provision in the tax code allows investors to defer capital gains taxes when they sell a property by reinvesting the proceeds into another like-kind property within a specified timeframe. This ability to defer taxes allows capital to compound without the drag of tax payments that would otherwise reduce the amount available for reinvestment. Over long periods and across multiple exchange transactions, this deferral can result in substantially more wealth than would have been created if taxes had been paid at each sale. For capital preservation purposes, these tax advantages are not just about maximizing returns. They are about keeping more of your capital intact and working for you over time. Let's talk about the role of real estate in protecting capital against systemic financial risk, which is the kind of risk that affects the entire financial system simultaneously. The 2008 financial crisis was a vivid demonstration of how interconnected and